Diksha and I welcome you back to TMR Talks. So, after a lot of restructuring in the banking sector and continuous problems that we've been observing, finally we have a banking company which has a 98-year long history and it is looking forward to getting listed on NSE and BSE. So, today I will be speaking about all the important aspects of CSB Bank Limited, this particular IPO. Now, first of all, let me tell you a few basic details about this bank. So, it is operating in 16 states and 4 union territories in India. It has got a strong base in Kerala. It has reached approximately 1.3 million customers till date, and the bank has got total 412 branches. Out of the 412 branches, 267 branches are only in Kerala. Now let us move ahead and understand what is the exact business model of the company and which are the segments in which it is operating. So these are the main four categories in which the bank is operating: SME, treasury operations, wholesale and retail. Now when we talk about banking company, one important thing that comes to the mind is what is the loan book of the company like. So this is the loan book of the company. All the figures here are in million. And I also have the breakup of it, which will give us a fair idea of the entire thing. So this is the breakup of the entire loan book. If you closely observe this particular thing, one thing is clear that the SME sector segment and the retail segment are the major drivers of this entire business. Now let me give you an idea of what SME segment does exactly. So SME segment, this is catering to financial institutions, agriculture, vendor and dealers of corporates. Plus the segment is offering higher yields, and strategically the company is planning to getting into MSME, and they also have this strategy to grow the SME customers by increasing the product offering. For example, supply chain finance or cash management services, plus opening salary accounts, right? And one very important and positive factor of this particular segment is that this loan portfolio is secured by tangible collateral by more than 90%. In fact, for March 2019, they have said that 99.26 of this entire loan given under this segment had been secured by tangible collateral, which is a big thing. Plus, one little concern here is that all this particular loans that are disbursed in this particular category, so 57 of this loan has got a BBB or below BBB rating, which is a point of concern. But along with that, I feel that there is collateral, so that is one thing, and also they must be charging higher interest rates because it is riskier loan that they are giving. This is about SME sector. Now talking about the retail loan, products under retail category include gold loan, vehicle loan, two-wheeler loan, personal loan, housing, agriculture, etc. Now under retail, gold loan constitutes a major portion. So as of HY20, approximately, I think 71% of it is gold loan. And if we were to talk about the total advances that are given by the bank, then around 30 to 33% is your gold loan book. And the company is really bullish on this category. They are aiming to keep the gold loan book at around 35% in the future as well. Third category is your wholesale. So under this, they mainly cater to large and mid-size corporates and other entities with a credit requirement of more than 25 crores. And again, to improve this, what they are planning is they are intending to leverage their relationships with various institutions such as education institutions, temples and churches and different trusts, etc. Also, one important strategy that the company is having is to expand the business. They are planning to open 425 branches in the next 5 years duration. So this is about the main categories of the bank and what they are doing. This is the exposure that this particular loan book is having to different industries. Their MD has said that they are not planning to increase the exposure of more than 5% in the industry segment, and in the service segment they have main exposure in NBFC and HFC, which is a little concern considering the problems that we are facing, that this entire sector is facing. Now after speaking about the advances, next comes your deposits, as to where is the company getting the deposits from. So this is where the company is getting the deposits from. These are the figures and everything is in million. I also have the breakup of this deposits, which will again give us a clear idea. So this is the breakup. From retail, we are getting more deposits, more than 90%. And below that, there is current account and saving account deposits, so which forms our CASA. So CASA ratio, it is improving, which is a good sign. By CASA, what we understand is that if there is more CASA, the company's cost of funding is reducing, because this is the cheapest way of getting the funding or getting deposits for any particular bank. Let's talk about a really important thing, that is the financial analysis and peer comparison. So this is the deposit and advances. So the deposits of the company have not moved as such in the past 3 financial years. Advances have gone up a little bit. Interest earned and interest expended, also interest earned has not changed in the past 3 financial years. Now let me pull up an Excel which will give you a clear idea of the ratios of the company, and will be able to understand how is the company exactly doing the business. So first we will start with the operating ratios. We have yield on advances and investment. So this tells us the income generated through your advances and investments. For advances, it is reducing, which is not a good sign. For investment, it has slightly improved, which is a good thing. Cost of deposit and fund shows us how much interest are we paying for getting this funds, which is reducing, and that is a positive signal. NIM, which is net interest margins, have also slightly improved, which is a good thing for the bank. And cost to income ratio is of a little concern, because it is growing, and that is not a good thing, which means the bank should be able to reduce their cost in the coming future, their overall cost that they are incurring in order to run the bank. Business ratios are showing us how much deposit is used for investment and for advances. Next is the productivity ratio. So productivity ratio shows us how much per employee business is generated plus per branch. So per employee business is not improved as such. Profitability per employee is going to be negative for the first 3 financial years, because the PAT was negative for the first 3 financial years. Business per branch has slightly improved, and your CASA, like I already told, is in a good situation. It is going up, and the number of employees are also improving in every financial year. Coming down to a very important thing, that is non-performing asset. The company is not having any issues, I think, related to the gross NPAs, because we can see that they have been reducing. If you talk about the gross NPA percentage, from 7.5 it has gone down to around 5% for FY19, and for half year 20 it is 2.89, which tells us that the bank has been focusing on NPA recovery and improving the asset quality. Plus, the one very important thing again, the capital adequacy ratio, it has improved. It has gone to 22.77% for half yearly 20, because of the funding that the company has received. They have received a funding of around 7,200 million in FY 2019, and they are going to receive around 4,800 million funding in FY 20. So on this front, there is no problem to worry. This is a really good sign if the company is having good capital adequacy ratio. Now, talking about the EPS, they have given the EPS of 2.57 for half yearly 20. So for entire year, we can consider the EPS to go to 5. Talking about the book value also, it is at 2.39. Now, the difference between book value and adjusted book value is that from the book value we remove revaluation reserves. That is giving us the adjusted book value, which is a much clearer picture. So this was about your financials. What we can conclude from this is that the major things which we look into the bank when we talk about a banking company, that is price to book value, is in a good situation. They've got good capital adequacy ratio. In fact, it is we can consider it to be really good. Talking about the peers also, when we talk about peers, you'll get a clear idea about that. Gross NPAs are also reducing, which is a good thing. I believe they should be working on improving their productivity overall and reducing their cost. Now I think we can go ahead and talk about the peer comparison as well. Here we can see the peer comparison table of different banks. And all these figures, by the way, are of March 2019. I'll also tell you what are the half yearly 20 figures right now. So the basic EPS was negative in March 2019 for the bank, but right now it is 2.57. So like I told, for the entire year it will be around 5. Price to book value right now is 2.39. Earlier it was 5.19. So it is somewhere closer to this peers only. Capital adequacy ratio, this bank has got the highest capital adequacy ratio. For half year 20, it is 22%, and it is the highest for this. And gross NPA also, the company has got gross NPA of only 3,200 million, which is lesser compared to other banks. Plus the gross NPA figures have been reducing, like we saw in that particular Excel. So if we were to conclude from the peer comparison, we cannot say that the IPO is overpriced, because it is at the same level. Companies having good adequacy, capital adequacy, plus the company is not facing gross NPA. They've been recovering the NPAs as well. So this was about your peer comparison. Now, these are the few details related to the issue. There is fresh issue of 24 crore and offer for sale of 385. So approximately 410 crores have been raised by the bank. Issue band is 193 to 195. They're going to list on both the exchanges in this 3 days, that is 22nd November to 26th November. And these are the exiting shareholders. So few insurance companies with whom the bank had tied up for selling their products are exiting from the firm. Now towards the end of the IPO, towards the conclusion, talking about the business strategy of the company, they are planning to expand their operations to 425 branches in the coming 5 years. And they will be focusing on SME and gold loan, which is a really good segment because they have got collateral secure. All these loans are secured by collateral. Plus the strategy is also to change the business model to function efficiently as a full service new age private bank. So from whatever we spoke about the bank, one thing is clear, that they have been operating as a traditional bank, and now since they have got funding, what they have mentioned in the prospectus is they will be moving towards a full service new age private sector bank, which means that a lot of things are going to be automated. We are already seeing in the private sector banks what is happening is the employees per branch are reducing, which is reducing their operational cost, helps in boosting the profits. Plus a lot of things is getting automated. So this will improve their cost to income ratio. Plus the main fundamental point of the banking, that is capital adequacy, NPA figures, the price to book value are all in a good shape, and the future of this company definitely looks promising. So if you are looking for a longer term perspective, it is a good bet to invest in this particular IPO. I hope this video has helped you in making your investment decision. If yes, then definitely like it, share the video, do subscribe our channel, and you can also mention the videos or the topics that we can cover in our upcoming TMR talks. We will definitely try to think about the suggestions that you give us. Thank you so much.